investors have differing expectations, so we try to present a range of outcomes and show you what mathematically would be the outcome for the bond index. Now, we can't obviously forecast our own returns, but we can say that we certainly hope to outperform over time. Historically, we've been able to do that, but present a whole number of scenarios and you work out how that fits into your portfolio in the context of the jigsaw of portfolio creation, and with good cognizant kind of recognition of what role does this asset actually play in your portfolio? What are you trying to achieve by an allocation to an asset such as ours? So with our scenario analysis, we've presented 8 scenarios. Inside of those 8, we have 4 where the RBA doesn't move interest rates over 2018, and we have 4 where they do hike in 2018. Now, that's not our central expectation, but we fully appreciate that some investors also expect that, so we'd like to present it anyway. And think about the relationship of all of your asset holdings in relation to what your central outcome is. Now, we clearly have our own bias, and our bias is that the RBA don't do anything with interest rates in 2018. They've been very explicit about that, and so we feel confident that it's somewhat of a benign year. But we know that risk markets will move around that, and there will be a range of outcomes over the year that, you know, it's a tough year to forecast in many respects. 2018, there are a lot of moving parts. There are risks that we haven't seen for some time. They are both positive and negative. On the positive side, things could keep continuing on. We know economic growth is strong, those types of things. The negatives come out of nowhere. They could be, anything like an earthquake in Los Angeles or Tokyo, or a Donald Trump moment, or a North Korean moment. We try not to focus too much on them, but that's exactly what we're here to defend and protect against. And so we're very cognizant of the fact that they are things that come to market periodically. They're often unforeseen, and so we need to think about those as well. But as we've presented our scenario analysis, it's been on the more optimistic side. So we have 8 scenarios that we've presented, 5 of which have the bond market statistically cheap. And so we understand, investors' expectations are probably more around that at this point. And we're just trying to debunk some of the sensationalism around bond returns. Bonds are very investable in any market phase, but particularly now as we approach this late cycle environment. So of our 8 scenarios, 5 of which are presented cheap, 2 at fair value, and 1 with a policy error where the RBA do hike interest rates, but then have to turn around and cut. Very similar to Glenn Stevens in 2007, 2008, who hiked into the world's biggest financial calamity and then cut aggressively at the end of 2008. We've certainly seen that before. It's absolutely possible. It's probably not probable, but it's possible. So we present it as well. In all those scenarios, we expect positive returns for the index, and certainly as an active manager, we would highly hope that we can repeat our outperformance of previous years and generate substantial outperformance over and above those numbers. But the whole thing is set up to be on very strong footing on the expectation that the markets have already established a pretty wide break-even or firewall for RBA rate movement. Now, we don't expect that to come to pass, but very much like an equity which is deeply discounted ahead of earnings, there is a big expectation that this could happen. And so if it doesn't happen, or even if it does happen, but only at the rate that investors are expecting, performance will be positive. So we're actually set up in a pretty nice space for 2018 performance. And we're very positive on the product this year, and given the increased volatility for an active manager, our ability to be able to navigate around that over the course of the year and drive additional return for investors whilst keeping risk at a low and tolerant point.